On March 14, 2008. Jim Cramer looked into the camera and told a viewer, "Bear Stearns is fine. Do not take your money out." 6 days later, Bear Stearns was gone. Sold for $2 a share. And that was cable news at its best. I've watched financial news for 50 years. Through Black Monday, the dot-com crash, 2008, COVID. And I'll tell you something that took me decades to accept. The people on your screen are not trying to make you rich. They're trying to keep you watching. Those are two completely different jobs. And today, I'm going to show you exactly how one destroys the other. Stick around for the third example, because it might be happening to your portfolio right now. Here's a question most investors never ask. Who actually pays for financial news? It isn't you. Even if you subscribe, your fee is a rounding error. The real customer is the advertiser. And advertisers pay for one thing, your attention, not your returns. Think about what that means. A network that tells you nothing happened today, hold your index fund, goes out of business. A network that screams market chaos every 12 minutes gets ratings. So the incentive is baked in. Urgency sells. Calm does not. A Vanguard study found that investors who check their portfolios daily trade roughly 10 times more than those who check quarterly. More trades means more fees, more taxes, more mistakes. The news isn't just noise. It's a tax on your wealth. And here's where it gets really interesting. Let's go back to 2008. On March 14th of that year, Jim Cramer, probably the loudest voice in financial television, told a viewer that Bear Stearns was safe. 6 days later, J.P. Morgan bought Bear Stearns for $2 a share. A company that traded at $172 a year earlier. Gone. Now, Cramer isn't stupid. He's a Harvard-educated hedge fund manager. So what went wrong? He was doing his job. His job is to have an opinion every single day. About every single stock. In real time. No human being can do that well. Nobody. Compare that to Warren Buffett. On October 16, 2008, while cable news was in full panic, Buffett published an op-ed in the New York Times titled "Buy American. I am." The S&P 500 was around 900 at the time. It would fall further to 676 in March 2009. But over the next decade, it would quadruple. Buffett wasn't a genius for calling the exact bottom. He didn't. He was a genius because he didn't care about the bottom. He cared about value. The news cared about the hour. Every year, a research firm called DALBAR publishes a study of how the average American investor actually performs. And the results are brutal. Over the 20 years ending in 2022, the S&P 500 returned 9.65% annualized. The average equity investor? 6.81%. That's a gap of nearly 3 percentage points. Per year. For 20 years. Think about what that means in dollars. $100,000 compounded at 9.65% for 20 years becomes about $620,000. At 6.81%, it becomes about $370,000. Same market. Same time period. $250,000, gone. Not to fees. Not to taxes. To behavior. And what drives that behavior? The news. Selling in March 2009 at the bottom. Buying in 2021 at the top. Rotating into whatever sector was on the cover of Barron's last week. The news doesn't make you smarter. It makes you emotional. And emotional investors pay the bill. Which brings me to something even more uncomfortable. Here's a fact that should stop every investor cold. Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990. Over those 13 years, he averaged 29% annualized returns. One of the greatest track records in history. But Fidelity did an internal study of the actual investors in his fund. And they found something stunning. The average investor in the Magellan Fund lost money. How is that possible? Simple. People bought in after a good quarter when the news was excited. They sold after a bad quarter when the news was afraid. They did this over and over for 13 years. And they turned the best fund on earth into a loss. The fund didn't fail them. The news cycle did. And every time you let a headline decide your next move, you're making the same trade those investors made. You're buying high, selling low, and calling it research. Here's what 50 years has taught me. The news tells you what happened. The market pays you for what will happen. Those are not the same thing. In fact, they are almost opposites. The news is a rearview mirror dressed up as a crystal ball. If you want to invest like Buffett, Graham, or Lynch, you don't need better news. You need less of it. Read the 10K, read the annual report. Read the footnotes. And when the television is shouting, turn the sound down. Your portfolio will thank you. Probably with interest. So here's my question for you. When was the last time a news headline actually made you a better investor? Be honest. Drop it in the comments, I read them. And if this changed how you think about financial media, hit subscribe. Tomorrow, we're going somewhere harder. We're talking about the one behavioral bias that even Buffett admits he struggles with after 60 years of practice. See you then.